All right, today we're jumping into a really fascinating piece from the Macro Butler that basically takes a core belief of modern finance and flips it completely on its head. We're talking about bonds, the safe part of your portfolio. Well, what if that's now the most dangerous place to be?
There's a great old quote from way back in 1929. Andrew Mellon famously said that bull markets end when gentlemen prefer bonds. And just to be crystal clear, he was definitely talking about the financial asset, not, well, you get the idea. For almost a century, that's been the wisdom. When things get crazy, you run to the safety of bonds. But here's the kicker, and this is the central question the Macro Butler is asking. What happens when that safe haven isn't safe anymore? What if it's actually become a trap? That's exactly what we're going to unpack right now. Okay, so first up, let's get into what the source calls the debt-soaked reality. And honestly, this is where you can see common sense and the actual market just completely part ways. So just look at this chart for a second. The green bars, that's U.S. government debt as a chunk of the entire economy. And you can see it just exploding skyward for decades. Now, basic logic would tell you, right, that as the risk of all that debt goes up, investors should demand higher interest payments, higher yields to compensate. But look at the red and blue lines. Those are the bond yields. They went down. It makes no sense. As the source puts it so well, reality chose satire. And hey, before we move on, let's do a super quick refresher on how bonds work, because it's really important. Just think of it like a seesaw. On one side, you have the bond's price, and on the other, you have its yield, or the interest rate. When interest rates in the market go up, the price of your older, lower rate bond goes down. It's this simple inverse relationship that's absolutely crucial for understanding the risk we're about to talk about. All right, now that we've got that relationship down, we can really start to see why that safety net is looking pretty shredded. It's time for section 2, busting the safety myth. We're going to look at the very real, but often hidden, cost of holding these so-called safe assets. Okay, this slide just lays out the illusion perfectly. On the left, you see the nominal returns. The green line for bonds looks okay, right? A little bit of a gain. But that's before the real villain of the story shows up, inflation. Now look at the chart on the right. This is the same data, but it's adjusted for the real cost of living, what the source hilariously calls the CPI fairy tale. And suddenly, whoa, that green line absolutely nosedives. Your safe investment has been actively losing you purchasing power. So how bad has it been? This one number tells the entire story. If you took $100 and put it into US bonds 5 years ago, today, you would have lost nearly $20 in real-world spending power. It's not just that you didn't make money, you actually lost it. That's a guaranteed loss, not a safe return. So the takeaway here is pretty stark. The Macro Butler is basically saying that clinging to these old ideas about bonds being safe, well, it's like trying to navigate a new city using an ancient crumbling map. The world has changed, the rules are different, and the old playbook is just totally broken. So, if the old playbook is broken, what's the new one? That brings us to what the source calls a new survival playbook. And it's all about a massive mental shift. We have to stop focusing on the return on capital, chasing profits, and start prioritizing the return of capital. In other words, just making sure you get your original investment back with its spending power intact. For years and years, this right here was considered the gold standard for a safe, balanced portfolio that could weather any storm. It's the classic permanent portfolio. Super simple, 25% in stocks, 25% in cash, 25% in gold, and there it is, 25% in bonds. Bonds were the stabilizer. They were the anchor. But the argument now is that this new reality demands a pretty radical change. Look at the right. The source calls it the Banana Republic portfolio. See what's missing? The bonds and the cash are completely gone. Both are basically just government promises, and they're replaced by doubling down on stocks and gold. The whole idea is to swap out those fragile promises for an anti-fragile asset, something that doesn't just survive chaos, but might actually get stronger because of it. And this quote just nails that shift in thinking. It's not about being greedy and chasing every last percentage point of return anymore. It's about survival. It's about making sure that at the end of the day, you haven't lost the value you started with. Okay, let's zoom out a bit because this whole thing is bigger than just numbers on a spreadsheet. It's about global trust, or the lack of it. This brings us to our next section, when chaos becomes policy and why what's happening on the world stage suddenly matters a whole lot to your portfolio. This chart really ties it all together. That wild blue line is something the source calls a chaos index. It basically tracks global turmoil. Think wars, sanctions, all that good stuff. The other lines, that's gold. And the pattern is, well, it's impossible to ignore. As global chaos goes up, trust in paper assets like stocks and bonds goes down, and gold shines. It's not a coincidence, it's the market passing judgment on the credibility of government.
So what's actually driving this chaos? Well, the source points to a few really big trends that are chipping away at the very foundation of trust that government bonds rely on. You've got the weaponization of finance, where assets can be seized. You have global trust being dismantled, one sanction at a time. You've got governments that are flat out broke and getting desperate. And you even have the erosion of property rights in places we used to think were untouchable. It's a really toxic mix.
And really, it all comes down to this one incredibly powerful idea from the source. When governance loses credibility, the sage steps aside, holding what cannot be printed and owning what produces. In other words, you stop trusting promises on paper and you start owning real things. So the big takeaway here is that the whole idea of a risk-free asset might just be a thing of the past. The game has changed. Now, if this analysis got you thinking and you want to go deeper down this rabbit hole, I highly recommend checking out more from the Macro Butler over at themacrobutler.com.